Welcome to week 6 of Financial Management for Nonprofit Organizations and our final lecture. This week we're going to look at 3 topics. Number 1, your board of directors and their role in the governance of the organization. Number 2, how to create and maintain strong internal controls. And number 3, using financial dashboards to communicate important information. So first, we'll look at governance and the board. In the broadest terms, your board of directors are responsible. Ultimately, they are the final entity responsible for ensuring that the mission of your organization is being fulfilled. That's a simple term, but it carries a lot with it. The board is the entity responsible for ensuring that the organization is following the law, is behaving in an ethical manner, and does not waste the resources, i.e. money, that are trusted in its care. Now, some of the standard roles that a board of directors member is expected to fulfill include hiring and supporting the chief executive. Yes, your CEO does have a boss, and that boss is the board. The board is expected to monitor the performance of the organization, to ensure that the organization is being managed responsibly. They are expected to conduct strategic planning every 3 to 5 years and to ensure that the organization has a development plan that aligns with the strategic plan, i.e. it's not enough to say in 3 years we'll have a new program. They also have to know that there's a way to develop to ensure the funds for this program will be and stay in place. And finally, they in fact are responsible for maintaining themselves, including identifying and recruiting good new board members. Board members don't last forever. They're not expected to. You have to have some turnover, and you have to know that they can recruit new good members. Every board has officers, and board officers are just regular board members with additional duties and responsibilities. Different states will have laws stipulating which officer positions your nonprofit must have, but generally they will be the chair, vice chair, treasurer, and secretary. Now, the board, again, is the accountable and liable body for the organization. And if the board is accountable, that means that the public can trust the organization. It means that funders, members of the public, politicians, government officials feel confident that it is fiscally well managed and performing what it is expected to do well. It means that the organization is sharing the necessary information, that the organization is transparent, and that the organization is matching its performance in its programs to meeting the goals that it has set. Board members are expected to know the laws. A board is expected to respect the donor intent, which means, as we saw in one of our assignments, if the donor gave a donation for a particular purpose, they want to be sure that that is where that donation ended up. The board is expected that the organization publish an annual report and that this report is available to the public. The board is expected to be confident that the organization is complying with the 990 regulations. It is filing on time, filling the forms accurately, and making them easily accessible. The board is not expected to do the 990, but ultimately they are the responsible party that it has been done and done correctly. The board is expected to monitor executive compensation. As we've discussed before, that is one of the first places where the public and any concerned people will look at in an organization. We certainly expect the board will value diversity, and that the board will be part of looking at performance indicators and setting measurable goals so that they can be sure the organization is accomplishing what it says it will accomplish. Now, then that raises the question of, is the board liable? The board is liable in certain ways. They are expected to fulfill what are known legally as 3 fiduciary duties. The duty of care, and that just means that they are making informed decisions and paying attention as any effective member of the public would. That means that when they make a decision, they have taken the time to understand it, that they are, which seems ridiculous but is not really a difficult concept, paying attention when things are discussed, which often means they are showing up at meetings. The next duty is the duty of loyalty, and that means that board members are acting in good faith and putting the organization's best interest front and forward, which also means that they are avoiding conflict of interests, particularly their own personal or business interests that could also be affecting board decisions. And what's known as the duty of obedience, which means that they are forbidding any acts that go outside the organization's rules, the organization's policy, mission statement, articles of incorporation, the organization's bylaws, and of course, all other laws. Now, in 1997, the Volunteer Protection Act was passed, which waives individual board members and volunteers from personal liability. And important to know that board members who are generally not paid in a nonprofit organization are in the same category as any other volunteer. And volunteer board members are free from personal liability. They cannot be personally sued for what happens at or a problem at the nonprofit unless they individually engaged in willful or criminal misconduct themselves, were guilty of gross negligence or reckless conduct. And this is extremely important because you want good board members, but people have to feel safe that they are not going to lose their home or their life savings because of a problem that occurred. So, your board is ultimately in charge of the organization. But in reality, board members are chosen primarily because of their personal giving and their fundraising capacity. They may be influential people in the community. They may be celebrities. They may be community members, people who are representative or family members of the people being served. So they have all these huge responsibilities and expectations, but they may know none of this. And therefore, it is essential and an important role for executive management and board members that all board members get really strong training and ongoing support so they can do their jobs well. And if I may put in a plug, boardsource.org, which has both speakers, trainings, webinars, and print material, is an excellent resource for all board development and support. Now, internal controls that you must put in place to prevent fraud. This is a really depressing subject, but it's true. Theft happens. And sadly, the smallest nonprofits are the most vulnerable because there's often just one person handling all financial matters and maybe even trying to handle a lot more than financial matters. So what can get stolen from a nonprofit? Property can get stolen. Checks get stolen. Checks that are being received from donors or members can get stolen. Cash, dollar bills received at special events can get stolen. A busy executive or board member who's signing the checks may be so busy that he or she just signs them without looking what is said on them. And sadly, there may be payments made to fictitious employees or unauthorized raises, unauthorized overtime, or even payroll taxes may not be submitted to the government. So the scary stuff, it happens way too often, but the internal controls you put in place can really, really put your mind at ease. And the most important internal control is called segregation of duties. And this means that no one person should have sole responsibility for any aspect of a financial transaction. No person should do any part of a financial transaction unless another pair of eyes or hands also are involved. And that includes even opening the mail, endorsing checks, recording deposits, acknowledging contributions, receiving bills in the mail, authorizing payment for these bills, preparing the checks, signing the checks, preparing payroll, recording bills and checks, reconciling bank balances, preparing journal entries, projecting and managing cash flow, preparing monthly financial statements, monitoring the budget, presenting finance reports to the board, and even preparing and filing annual tax forms. Now, 3 very easy ways to keep a lot of fraud from happening involve cash, payroll, and working with contractors. And in this case, we're talking cash as in dollar bills. And very simply, anytime cash is received, such as an event, or anytime cash goes out, such as petty cash, every one of these, no matter how small, should have a numbered receipt that's kept. The most important way to manage and control fraud in payroll goes to the role of each department manager. Every department manager is accountable for the number of staff that show up on payroll and the hours that they worked. And every manager must review payroll reports regularly and look for variances. Now, there may very well be a variance in what you thought would be the number of hours a job took or the number of staff you budgeted, but the manager must see the variance and be able to explain it in full confidence that they understand why this has happened. Contractors, sadly, are another place where fraud is possible. And again, it's the role of each manager to know what work has been authorized and what it ended up costing. And they must look for variances in the financial statements to see if there's a difference between what they projected and what they ended up paying for contract work. Again, there may very well be variances, but the manager must sign off on it before payment is made and must understand what it is. So why isn't all this just done routinely? Again, in smaller nonprofits, there just aren't enough staff people to separate these functions. They're trying to keep the administrative costs down. So take a look back at your textbook on pages 261 and 2 to see some very nice ways that even a 2, 3, or 4-person organization can break down these tasks to make sure that no one person is the only person in charge. Another important avenue in internal controls is reporting. It is vital that you and others are reviewing your financial reports regularly. You know you're generating the statement of financial activities. Remember, that's revenue and expenses. Your statement of financial position, the balance sheet. Accounts receivable aging report tells you how long your invoices are outstanding, your cash flow projections, your utilization reports, which most typically show staff hours per week or per payroll. And review back again in your textbook, pages 69 to 73 and 75 to 76. But it's not enough that you generate these reports. The buck has to stop with you. You have to look at these reports with a clear eye to see anything that's not what was expected and understand to your satisfaction why there is a variance. Of course, there'll be variances, and it's usually fine. But if you don't understand it, you must keep pursuing it until you are satisfied. An important aspect of maintaining your controls has to do with communicating policies. So ask, are there written policies and procedures in place for handling all financial transactions? Well, probably not. But in the meantime, can there at least be shared documented communications about how all transactions should correctly be done? You want something in writing to show that this was communicated and received. An interesting additional concept is called cues, control cues. And this is what informal subconscious messages management is sending. What is the culture of the office, of the organization? For instance, does the manager use the copier for personal use? Well, of course, that's a normal thing to happen. But in the manager's mind, he or she has a very clear idea. Yes, I can make a couple of copies for something that I have to send to my bank. But no, I am not going to use it to copy a textbook. I'm not going to use it as my personal copier for all things. The manager knows that. But that's just in the manager's mind, what's okay and what isn't. It needs to be communicated. You cannot assume that all your staff are reading your mind or coming from the same place you are. Is petty cash just an open box? What is petty cash being used for? If there's usually a small amount of money, it's not a critical function, but is the culture one that says, every penny of our organization is the public's trust and we can document it, or is that not what the culture is actually saying? So really, are the management's actions modeling the behavior that he or she expects from everyone else? And I would say not just modeling. These can be open and regular discussions. You don't have to dance around this subject. The more you communicate, the less you are asking people to read your mind. And again, record keeping is essential for protecting yourself and ensuring that any fraud can be nipped in the bud. Record keeping has to be consistent. Some interesting suggestions are to take some of this off of your staff hands. Use a payroll service that have no personal connections to the people involved. There are, in fact, accounts receivable services to make sure your money is coming in, or specialized software to track it. You can increase your bank's role to help manage cash. For instance, all checks could be sent directly to the bank, not to the office. That's called a lockbox service, and the bank can automatically move this cash once it reaches a certain point into the account that you have designated. There's application service providers where you lease your software from a provider so that it is backed up externally. Your information is more secure. You don't have to worry or risk accusing anyone of hacking your information. And finally, you will get annually or biannually an audit, and it will include the management letter. It will have a checklist of internal controls that should be in place or must be put in place to maintain and improve your internal controls. Pay real important attention to this checklist. Do what it says. An interesting thing you can do that will really prevent a lot of fraud and nip it in the bud is require that your key staff in the financial department, or even key staff in each department, take a 2-week vacation every year. Any unorthodox activity that's been going on is going to become apparent over 2 weeks. And people, if they know that could happen, they will behave themselves. And if they haven't been behaving themselves, you will catch it right then. This is all very difficult. We're in the nonprofit world because we believe in people. We want to help. But just because you're building and maintaining a system of checks and balances is not saying that you don't trust people. It's sound, standard financial management. And I like to look at it as, rather than saying you don't trust people, you are building a system to keep these people safe, to keep your staff safe from accusations or distrust, because they know what to do. They are following procedures that are standard, and it's not up to them to know what's on your mind or what anyone meant. In truth, the best thing you can do for your staff is to put in place strong internal controls to show that you believe in them. Okay, finally, last subject is dashboards. Now, in the car, we have a dashboard because it gives us immediate and easy to see key information. Without taking our eyes off the road, we can easily see how fast we're going. We can easily see how much gas is left in the tank, and so on. It's easy to read, we know to look for it, and we can keep doing what we have to do, which is watching the road while getting this information. It's the exact same principle you can use when reporting information, including financial information, particularly to your board. So the dashboard is the same information that you already have developed, but it's providing this information in an easy-to-see format. It's also important that it is a comparison. It is showing this information compared, usually historically, to prior years. So first you have to decide what is the most important information. And that part of that answer is what is most relevant to the financial health of your organization. Obviously, revenue, expenses, the balance, cash flow, net assets. A particular revenue based on your organization. It could be how government grants are doing, how fundraising is doing, or a particular expense, particularly personnel costs, as that's usually the largest expense. And then what are you comparing the current figures for any of these with? Again, you could look at how these figures looked last year at this time, or how it looks actually compared to the budget. But there are many other things the board could understand easily in a dashboard. In fact, every activity and department of an organization could create a dashboard. There could be a fundraising dashboard, a facility maintenance dashboard, human resources dashboard. In fact, the board could even create a dashboard to monitor its own performance, number of meetings held, number of people attending meetings, number of new board members recruited, etc. Certainly, you could look at creating dashboards for your program performances, a transparent, easy way to look at how well or not your programs are fulfilling their missions. A dashboard on number of people served, a dashboard of the numbers of goals met or percentages of goals met. Could be numbers who graduate high school or gain a job or remain sober for 6 months, etc. It could be the numbers of hours of counseling that people are going to in your organization, so on. The question is how you can, once you've decided on these numbers, how do you present them so that they are immediately understandable? The most important information has to jump out at the reader. And that's when you can use colors, fonts, shading. There's all kinds of charts, graphs, informatics, but you want to keep it simple. Excel has great templates and formats for dashboards, but don't let it get overcomplicated. Keep it simple or it will be ignored. And finally, here are a few nice examples of dashboards. You can see many more examples. It does not need to go into graphs and charts and visuals. They may be helpful, but they have to be worth it. But it's an excellent way, not just for your board, even for other staff, to know at a glance how things are going so you can plan accordingly.